Hello everybody and welcome to another video. Today is Tuesday, November 27th, 2018. I just wanted to make this quick video today because I think it is extremely important and a topic that is not really talked about a lot. So first of all, thank you guys for tuning into the video. If you're not already subscribed, I would really appreciate if you hit that subscribe button below on the YouTube video and become a subscriber here. You can watch all of my free videos coming out both now and more to come in the future. Also check out the podcast if you'd like to hear more from me. It's Robot Trading Radio on SoundCloud as well as iTunes. So give that a listen. And if you're not already in our free Telegram or Discord groups, those will be linked below. Come join us. Lots of free analysis almost daily. Okay, so let's get into the video here. Today I want to talk about how banks trade. A lot of people think they know how a bank trades. A lot of people will tell you on the internet to use things like bank support and resistance levels or very obvious indications that the banks have bought or sold at a certain point. But what I'm going to tell you is that most of the time, when a bank has bought and sold, you won't really see it until it's too late. But instead, we can actually kind of predict the way they work. It's actually somewhat consistent, and psychologically, it makes a lot of sense. So let's get into it. How does a bank trade? The best way to first acknowledge how a bank trades is to perhaps look first at how the retail traders trade. Retail traders like to follow a trend, and they like to use tight stop losses and basically have a low risk to high reward, risk to reward ratio. So if that's the way retail traders trade, they trade with the trend after it's already a confirmed trend, and they use tight stop losses. We also know that retail traders lose 90% of the time. Most of the time, retail traders lose money. Partially because they have terrible risk management, partially because they have terrible discipline, but also because psychologically they get manipulated by the banks. So let's talk about it. Let's talk about a scenario on the chart ahead of you, in front of you right now. On this chart, what do we see? Let's assume, first of all, that there's a trend coming from the left here. We have an upward trend, and we get a pullback. Well, traders have been taught from YouTube videos, from mentors, from even banks and brokers who want you to trade a certain way. They've been taught that this is a good place to go long. It's been a move upwards, and now we have a pullback, and we're going to go long. Now, that's not necessarily wrong. However, banks know how little guys like to trade. They know how we approach the market. So they can actually take the other side of our trades. And in fact, that's what they do. They make their money by taking money from people who are predictable. So what do people do? I'm going to use red here. They come in here and they take a buy trade. We've had an uptrend, pullback, they take a buy trade. Where do they put their stop losses? They put it somewhere below recent support. And they put their targets somewhere up here. Some will take off positions here, something like that. So they've gone long here, hoping that price will bounce. But that's not what happens. In fact, the banks know where and what you're going to do at this level. So they actually do the opposite. So they know that retail is going long, anticipating that the trend will continue. Meanwhile, banks have pushed price up all this way and convinced people that they should go long. So the banks take a short position. So at this level, price not only does not bounce, but it hits your stop loss and everybody else who tries to get in late to a trend. And what happens? We see a down motion. We see a strong sell-off. And at this point, retail's trying to go long. But As price rolls over and it becomes clear that the trend has reversed and that the trend is down, that's where we see retail again make the same mistake. At this point, the retail traders begin going short. Down here, in this area down here, the trend is clearly down and retail is going short. So what does the bank do? They're long. At this point, maybe here, maybe here, maybe here, they are accumulating long positions. All of the retail guys who are jumping in late to this trend to go short, they are taking, the bank is taking positions on the other side. They're loading up longs here, loading up longs here, and loading up here. Why do banks have to load up at multiple entry points? It's because they have so much money to trade with that they need lots of liquidity or trading volume in order to fill their position. So all the retail guys who are short all the way down here are feeding positions to the banks who are going long. So from there, what do we see? Once banks have accumulated enough long positions, price reverses back up. And what happens, do you think? It's probably getting predictable by now. What do you think retail does here? They go short. So we've had this clear, defined downturn. And at this point, retail is highly predictable. They've been convinced the price is down, so they go short. And once again, they get stung and price goes up. Banks have loaded up here, price goes up here, and again, the process starts over again. Again and again and again, this is the way that banks make money. They take money from the retail guys by being one step ahead of them at all periods of time. So with that said, what can we do about this? Well, this is primarily the reason that I am somewhat of a contrarian or a counter-trend trader. Now, I don't look for shorts right away on just a pullback. I do, however, look for long positions. I don't look for long positions right away on a trend. When a trend is long run, when it is getting tired, you can see price is a long time going south. Down here, I'm interested in potentially taking long positions like the banks, because you know that this is how the banks trade now. They do the opposite of retail. It's very simple. Retail loses 90% of the time. Banks are on the other end of the trade, and they take advantage of the little guy who tries to ride the trend all the time. Now, trend following can actually work, but you don't want to be always late to the trend. At this point, in my opinion, I look for longs because I think that eventually that's what the bank wants to do. The bank has made their money on the way down. They were entered up here, so they cash out and they take it the other way. So as retail guys, we can actually mimic this. But my approach is not tight stop losses, and my approach is not trend following. I use counter trend trading, and in a similar way, I've mimicked my trading to as close to the banks as I know. Here, I take a first position. And maybe if price gets down here, a second position. Very small. For a small account, you might even use 0.01 lot sizes here, 0.01 lot sizes here, and no stop loss. A lot of people don't like that. It scares them. They think they can lose a lot of money. But this is trading. You can lose a lot of money no matter what. If you have a stop loss in place and price falls out of bed, your stop loss is not going to get protected. I can show you another example of that at some point in the future. There was a point on the Euro-Swiss chart, maybe in 2015, where price fell over 2,000 pips in one day. And retailers who had a stop loss in, if you think you were respected, you were very disappointed because a lot of people ended up owing not just their entire account. Their entire account went to zero, but they also ended up owing their broker tens of thousands of dollars more than they even deposited. So I don't use a stop loss. But I do use another method of risk management. I use very small lot sizes. I use 0.01, 0.10, 0.20, lot sizes like that. I don't use big lot sizes. Instead, I use small lot sizes and patience and a defined entry. So that's kind of my method in a nutshell. If you want to learn more, you can totally join my team. We talk about this method a lot. If you want to be different than the retail traders, you have to think differently than the retail traders. I try to mimic my trading as close as possible to the way that the banks trade. They don't use tight stop losses usually. What they'll use is multiple entries and accumulate a position before taking price higher. So that way they've got their full position loaded up, and then they can take price higher and offload up here. So with that said, that's really all I wanted to go over with this video. I wanted to open your eyes to the way that banks trade, because nobody shows you this stuff. This is not what is told to retail traders. Retail traders are told that at this point they need to be looking for sells only. You never go long down here. That seems ridiculous, right? Well, what happened here? We had a nice reversal to the upside. And that's because the banks, they load up down here. They don't buy up here. They don't sell down here. They buy down here and they sell down here. Buy low, sell high. Keep it simple, guys. If you want to come join my team, I'd be happy to have you. All the links will be down below. You can send me an email. You can contact me on Instagram, Telegram, Discord, whatever you want. Send me a message, guys. Thank you guys for listening. Hope you enjoyed the video, and we will catch you on the next one.